What if I told you that the next big stock opportunity isn't hidden on Wall Street, but right in your daily life, at the shops you visit, the products you use, and the trends you notice before anyone else? In today's video on Money Library, we're diving into the powerful ideas from One Up on Wall Street by Peter Lynch, a book that completely changes how you look at investing. This isn't about complex formulas or expert predictions. It's about using what you already know to make smarter financial decisions. By the end of this video, you'll understand how ordinary people can beat professional investors, how to spot winning companies early, and how to build long-term wealth with simple, practical thinking. So stay with me, because this might just change the way you see money and opportunities forever. 1. The core idea. You already have an edge. Lynch begins by challenging one of the biggest mental barriers in investing, the belief that ordinary people cannot succeed because they are not experts. He argues that this mindset is not only wrong but harmful, as it prevents individuals from recognizing their own natural advantage. Most people assume that professional investors always win because they have better data, research teams, and resources, leading them to rely blindly on expert opinions. However, Lynch points out that by the time analysts publish their recommendations, much of the opportunity is already gone. Instead, he introduces a powerful idea: you, as an everyday consumer, experience trends before Wall Street does. Through daily activities like shopping, using apps, interacting with services, and observing what people around you prefer, you gain early exposure to consumer behavior, popular products, and emerging trends. For example, noticing a constantly crowded cafe, a brand suddenly gaining popularity, or a product frequently out of stock is not just casual observation, it is early business insight. This timing advantage is crucial, because trends are first noticed by consumers, then reflected in company performance, and only later highlighted by analysts and the media, meaning those who recognize opportunities early can benefit from the full growth phase. However, Lynch highlights a key problem. While most people see these trends, very few connect them to investing, remaining passive observers instead of active thinkers. He encourages a shift from a consumer mindset, simply enjoying products, to an investor mindset, where you ask whether the company behind the product is growing and worth analyzing. At the same time, he cautions that observation alone is not enough. Liking a product does not guarantee a good investment, as the company may have underlying issues such as high debt, weak profits, or poor management. Therefore, the correct process is observation followed by curiosity, research, and then investment. Ultimately, Lynch redefines your edge not as superior intelligence or access to insider information, but as the ability to notice trends early, stay curious, and act logically on what you observe. His core message is simple yet transformative. Opportunities are already present in your everyday life, but success depends on thinking deeper about what you see and turning simple observations into informed investment decisions. The real advantage lies not in seeing more than others, but in understanding more from what you already see. 2. Invest in what you know, but don't stop there. Lynch presents the famous idea. Invest in what you know, but clarifies that it is often misunderstood by beginners who assume it simply means buying stocks of products they like or use, which is a dangerous and emotional approach. Lynch strongly emphasizes that personal preference is not enough. The real meaning is to use familiarity as a starting point, not a final decision. The correct approach is a structured process. You notice something promising because you understand it, then you analyze it through research and logic before deciding to invest. This matters because understanding gives you a major advantage. Without it, investors rely on tips, panic during market fluctuations, and lack clarity on when to buy or sell, whereas with understanding, they gain confidence, think independently, and remain calm during volatility. Lynch's method begins with observation, such as noticing a popular product or growing trend, followed by curiosity, asking why it is succeeding, then moving into research by examining profitability, revenue growth, and expansion potential, and only after that making an informed investment decision. For example, instead of blindly investing in a popular clothing brand, a smart investor would evaluate whether the company is profitable, growing consistently, and facing manageable competition. This approach also provides a psychological advantage, as investing based on knowledge rather than emotion helps maintain rational thinking even when prices fluctuate or negative news appears. However, Lynch warns that even familiar companies can be poor investments if they lack profits, carry high debt, or are overpriced, reinforcing his core principle to always know what you own and why you own it. He further simplifies this with a powerful rule: if you cannot explain in simple terms what the company does, how it makes money, and why it will grow, then you should not invest in it. Ultimately, his message is that invest in what you know does not mean blindly trusting familiarity, but using it as a starting point and combining it with research, logic, and discipline, because while familiarity can generate ideas, only proper analysis can turn them into successful investments. 3. The 6 types of stocks. Lynch introduces a powerful strategic framework by explaining that not all stocks are the same, and treating them as if they are one of the biggest mistakes investors make. Many people fail because they expect every stock to grow quickly or behave in a similar way, but Lynch solves this confusion by classifying stocks into 6 distinct categories: slow growers, stalwarts, fast growers, cyclicals, turnarounds, and asset plays, each with its own behavior, level of risk, and investment strategy. This classification is crucial because most investing mistakes come from having the wrong expectations, such as expecting rapid growth from a slow, mature company or buying a cyclical stock at the wrong point in its cycle. Slow growers are large, established companies with minimal growth and are best suited for stability and dividend income rather than price appreciation. While stalwarts are strong, well-known businesses with moderate growth that offer a balance between safety and returns, especially when bought at undervalued prices. Fast growers, which Lynch considers the most important category, are smaller companies expanding rapidly and are the primary source of 10-baggers, though they come with higher risk and require long-term holding and careful monitoring. Cyclical stocks, such as those in industries tied to economic cycles, move up and down depending on economic conditions, making timing critical. Investors should buy when the business is weak but improving and sell when conditions peak. Turnarounds are struggling companies that may either recover dramatically or fail completely, making them high-risk, high-reward opportunities that require a clear understanding of their recovery potential. Asset plays, on the other hand, are companies with hidden or undervalued assets that the market has not yet recognized, offering opportunities for those who can identify this hidden value through deeper analysis. Lynch's core message is that before investing in any stock, you must first ask what type of stock it is, because your expectations, strategy, and risk assessment all depend on this classification. The biggest mistake to avoid is treating all stocks the same, for example, expecting a slow grower to deliver explosive returns or holding a cyclical stock for too long. Ultimately, his insight is simple but transformative. Successful investing is not just about picking the right stock, but about understanding what kind of stock you are investing in and applying the right strategy accordingly. 4. The importance of research. Do your homework. Lynch makes it clear that once you've found an idea, understood it, and classified it, the most critical step is research, because this is what determines whether your idea becomes a successful investment or a costly mistake. He emphasizes that research is not about complex formulas, technical jargon, or predicting stock prices. You don't need to be a finance expert to do it well. Instead, research simply means understanding the business clearly, how the company makes money, why it has the potential to grow, and what risks could affect it. Lynch encourages a common-sense approach where you ask basic but powerful questions. What exactly does the company do? How does it earn revenue? Is it consistently growing in sales and profits? Is it actually profitable? Does it carry too much debt? And whether its expansion plans are realistic and sustainable. Beyond this, he introduces the idea that every stock has a story, whether it's rapid growth, recovery, or cyclical improvement, and your job is to understand that story and verify it with real data. This is where many investors fail, because they believe the narrative but ignore the numbers. Lynch insists that the story and financial performance must always match. To keep things grounded, he gives a simple test. If you cannot explain the company in a few clear sentences, what it does and why it will grow, then you don't understand it well enough to invest. This connects to his core rule. Know what you own. Because when markets fluctuate, understanding gives you confidence while ignorance leads to panic. Unfortunately, most investors skip this process, relying on tips, news, or copying others, which results in confusion, fear, and poor decisions. According to Lynch, the ideal investor is not overly technical but curious, logical, patient, and independent in thinking. Ultimately, his message is that research is not about intelligence or complexity, but about clarity and discipline, understanding the business, checking its growth and financial health, evaluating risks, and confirming that the story is real. The key takeaway is simple yet powerful. The best investment is not the one that looks exciting, but the one you truly understand. 5. The myth of market predictions. Lynch delivers a bold and counterintuitive message. Investors should stop trying to predict the economy because it does not lead to better investment decisions. Most people believe they need to track interest rates, inflation, GDP growth, government policies, and daily market trends, assuming that understanding these factors will help them succeed, so they constantly follow news, listen to expert opinions, and wait for the perfect time to invest. However, Lynch points out that even professionals consistently fail to predict the economy accurately because it is incredibly complex, influenced by countless variables, and constantly disrupted by unexpected events like recessions, policy shifts, or global crises. The real problem arises when investors rely on these predictions. They delay investing, miss valuable opportunities, and attempt to time the market, often leading to inaction and lost growth. Instead of focusing on uncertain macroeconomic forecasts, Lynch suggests a much more effective approach. Concentrate on individual companies by asking whether the business is strong, growing, and has a competitive advantage, because great companies can perform well even in weak economic conditions. While the economy affects all businesses, it does not affect them equally. Some adapt, innovate, and continue growing regardless of external conditions, and these are the companies worth investing in. He also explains that following economic news creates an illusion of control, making investors feel informed but actually increasing confusion and emotional decision-making, whereas true control comes from focusing on what you can understand: your research and your investment choices. This idea ties closely to the concept of time in the market versus timing the market, where attempting to predict perfect entry and exit points usually fails, while staying invested in strong companies over the long term leads to real wealth creation. Lynch advises investors to ignore daily noise, short-term predictions, and market panic, as these do not impact the long-term value of a solid business, and instead focus on meaningful factors like earnings, growth potential, business models, and competitive strength. Ultimately, his message is simple yet powerful. You don't need to predict recessions, inflation, or market crashes to succeed. You need to identify strong businesses with long-term growth potential. Because while the economy is unpredictable, great companies are recognizable, and success comes from focusing on what you can understand rather than what you cannot control. 6. Risk, what it really means. Lynch completely redefines the idea of risk by challenging the common belief that stocks are risky simply because their prices go up and down. Most investors traditionally define risk as volatility, market crashes, or short-term losses, so when they see a stock fall significantly, they immediately panic and assume it has become dangerous. However, Lynch offers a much deeper and more meaningful definition. Risk is not price movement but not knowing what you're doing. This shift in thinking changes everything, because it means a stock is not inherently risky just because it falls. Rather, it becomes risky when the investor lacks understanding of the business. To illustrate this, consider two investors holding the same stock. One who bought it based on a tip without understanding the company will panic and sell during a downturn, while another who has researched and understands the company's growth will remain calm or even buy more. The difference in outcome comes entirely from knowledge. Lynch also explains that price movements are often driven by news, emotions, and market speculation, which do not always reflect the true value of a business. For example, a strong company's stock may drop due to market panic even though its fundamentals remain unchanged. This leads to an important distinction between temporary declines, which are normal and expected, and real risk, which comes from fundamental problems like declining profits, excessive debt, weak business models, or slowing growth. Understanding a company deeply allows investors to separate these two, reducing fear and enabling logical decision-making instead of emotional reactions. This understanding builds conviction, which is essential for staying patient and making rational choices, whereas a lack of conviction leads investors to follow the crowd and panic during volatility. One of the biggest mistakes people make is fearing price fluctuations while ignoring the actual fundamentals, causing them to sell strong companies during downturns and hold weak ones out of hope. Exactly the opposite of smart investing. Lynch's approach to reducing risk is simple but powerful. Focus on understanding the business, conduct proper research, and avoid blind investing, rather than trying to avoid the market or react to short-term volatility. Ultimately, his message is that risk does not come from the market itself, but from the investor's lack of knowledge and clarity. Because when you don't understand what you own, everything feels risky, but when you do, you remain in control. The key takeaway is clear. The biggest risk in investing is not losing money but investing without understanding. 7. The concept of 10 baggers. Lynch introduces the powerful concept of 10 baggers to explain how real wealth is created in investing, emphasizing that you don't need to be right all the time, you just need a few big winners. A 10 bagger is simply a stock that grows 10 times your investment, for example turning 1,000 into 10,000, and Lynch argues that just one such investment can outperform many average ones, cover losses and significantly multiplying your wealth. These 10 baggers are usually found in fast-growing companies, often small or mid-sized businesses with strong demand and expansion potential that are not yet widely discovered by large investors. Spotting them early often comes from everyday observations, such as noticing a brand becoming popular, a product widely loved, or a company expanding rapidly, but this must always be followed by proper research before investing. However, the hardest part is not finding these opportunities but holding on to them. As most investors sell too early due to fear of losing profits, satisfaction with small gains, or anxiety caused by market volatility, even though the stock may have much greater long-term potential. This behavior is rooted in human psychology, where people are naturally inclined to take profits quickly and hold on to losing investments in the hope of recovery, which ultimately destroys wealth. Lynch advises doing the opposite, holding strong companies and cutting weak ones. To truly benefit from 10 baggers, investors need patience, because real growth takes years, conviction, built through research and understanding, and discipline, to ignore short-term noise and stay focused on the long-term story. Lynch also acknowledges that not every investment will succeed, and many may fail or deliver average returns, but this is acceptable because just one or two 10 baggers can offset multiple losses and still generate strong overall results. This leads to a healthier portfolio mindset, where you don't expect every stock to succeed, but instead aim for a few that succeed significantly, reducing pressure and emotional stress. Ultimately, Lynch's message is that wealth is not built through frequent trading or small gains, but by identifying great companies and holding them long enough for their full potential to unfold. The key takeaway being that you don't need many winners, just a few great ones that you have the patience to hold. 8. The importance of patience. Lynch explains that even after learning how to find ideas, research companies, and identify great investments, most people still fail in the stock market for one simple reason: lack of patience. The reality is that the stock market does not move in a straight line. It goes up, down, and sometimes sideways, and even the best companies can fall 20 to 50% or remain stagnant for long periods, which is completely normal. However, investors expect that once they buy a good stock, the price should continuously rise, and when this expectation clashes with reality, it creates frustration. This leads to emotional reactions. When prices fall, people panic, doubt their decisions, and sell quickly, and when prices rise, they become excited and buy more at higher levels, ultimately resulting in buying high and selling low. Lynch emphasizes that time is the greatest advantage an investor has, and real wealth is created not through constant buying and selling, but by staying invested and allowing businesses to grow over years. This is especially important when it comes to 10 baggers, which take time to develop through consistent performance and expansion, and without patience, investors exit too early and miss life-changing gains. Investing often feels like doing nothing, buying a good company and simply waiting, but this waiting game is uncomfortable because humans naturally want action and quick results. However, in investing, doing nothing is often the smartest move. Patience becomes easier when you truly understand what you own, because research builds confidence and helps you stay calm during price drops. The biggest mistake investors make is thinking in the short term, days, weeks, or months, while Lynch focuses on years, recognizing that real business growth and compounding take time. He also highlights the difference between market noise and business reality. Daily price movements are emotional and unpredictable, while actual business growth is gradual and logical, so investors should focus on earnings and expansion rather than short-term fluctuations. Holding investments is not passive. It requires discipline, emotional control, and the ability to ignore fear and hype while staying focused on long-term goals. Ultimately, Lynch's message is that knowledge helps you choose the right stocks, but patience allows you to benefit from them, and without it, even the best decisions can fail. The stock market rewards those who wait, not those who react. 9. Common mistakes investors make. Lynch explains that success in investing is not just about making brilliant decisions, but more importantly about avoiding common and costly mistakes that most investors repeatedly make. One of the biggest errors is following tips blindly, whether from friends, TV, or social media, without truly understanding the company, which leads to confusion, poor decision-making, and panic during market fluctuations. Similarly, many investors jump into stocks that are already rising, a behavior known as momentum chasing, where they enter too late at high prices, resulting in high risk and low reward. Emotional decision-making is another major problem, as fear during market declines leads to panic selling, while excitement during rallies leads to overbuying, ultimately causing people to buy high and sell low. Lynch also highlights the issue of overdiversification, where investors hold too many stocks, making it difficult to track them properly and resulting in average returns instead of meaningful gains. Instead, he recommends owning fewer companies that you deeply understand. Another critical mistake is ignoring the actual business and focusing only on stock prices or market trends, even though true value comes from earnings, growth, and business strength. Many investors also try to time the market by predicting highs and lows, but this is nearly impossible and often leads to missed opportunities and inactivity. A particularly damaging habit is selling winning stocks too early out of fear or the desire for quick profits, which prevents investors from benefiting from long-term growth and potential 10-baggers, while at the same time holding on to losing stocks too long in the hope they will recover, locking in losses and wasting capital. Additionally, following the crowd creates a false sense of safety, but often leads to entering investments late during hype cycles, when risks are highest. Finally, a lack of patience causes investors to expect quick results, leading to frequent buying and selling and ultimately poor outcomes. Lynch's core message is that most losses do not come from bad markets, but from poor behavior, and if an investor can avoid emotional decisions, blind investing, and herd mentality, they are already ahead of the majority. The ultimate takeaway is simple yet powerful. In investing, avoiding mistakes is far more important than finding perfect opportunities. 10. When to buy and sell. Lynch simplifies one of the most confusing aspects of investing, when to buy and when to sell, by explaining that most investors don't struggle with finding stocks, but with timing their decisions. People often believe that buying and selling should depend on market conditions, news, or price movements, but Lynch strongly rejects this approach and calls it a mistake. Instead, he teaches that buying should be based on the strength of the business itself, a company with a clear model, strong demand, and competitive advantage, along with visible growth in sales, profits, and expansion. Equally important is understanding the story of the company, what it does and why it will grow, and ensuring the price is reasonable, not driven by hype. He warns against buying stocks you don't understand, following tips, or investing just because something is popular, emphasizing that if your only reason is, everyone is buying, you should stay away. Lynch also clarifies that there is no perfect time to buy. The right time is simply when the company is strong and the opportunity is clear. When it comes to selling, he highlights that it is even more difficult than buying and should only be done when the original reason for investing changes, such as slowing growth, weakening business performance, rising debt, or poor management decisions. He cautions against selling based on emotional triggers like price increases, market volatility, or negative news, as these do not reflect the true condition of the business. One of the biggest mistakes investors make is relying on price-based decisions, buying when prices rise and selling when they fall, which is the opposite of smart investing. Instead, Lynch emphasizes focusing on business performance, holding strong companies for the long term, and cutting weak ones when fundamentals deteriorate. He also stresses long-term thinking, where decisions are based on years of growth potential rather than short-term price movements. Ultimately, his message is clear: buy when the business is strong, growing, and understandable. Sell when the story breaks and fundamentals weaken, and ignore market noise, because successful investing comes from logic, patience, and discipline, not from reacting to price. 11. The big picture philosophy. Lynch brings everything together by explaining that investing is not a one-time action but a continuous, repeatable process that connects all the ideas you've learned. Finding opportunities, researching companies, managing risk, staying patient, and making smart buy and sell decisions. Most people think investing simply means buying a stock, but Lynch reframes it as a cycle that involves observing the real world, thinking critically, researching deeply, making a decision, holding with patience, and constantly reviewing your position. The full system begins with noticing trends and spotting growing businesses in everyday life. Then focusing only on companies you understand, classifying them correctly to set expectations, and doing proper research to build conviction by analyzing their business model, growth, and risks. From there, you ignore market noise and stop trying to predict the economy, understanding that real risk comes from lack of knowledge, not price fluctuations. You then look for big winners like potential 10-baggers, hold them patiently to let compounding work, avoid common mistakes like emotional decisions and herd mentality, and finally make logical buy and sell decisions based on fundamentals. Buying when the business is strong and selling only when the story changes. What makes this philosophy powerful is the mindset shift it creates, moving away from trying to predict the market, follow experts, or time perfectly, and instead focusing on observing, understanding businesses, and staying disciplined and patient. Lynch keeps investing simple by emphasizing that you don't need complex math or technical knowledge, but rather common sense, curiosity, and consistency, while also encouraging independence, thinking for yourself instead of following the crowd. Ultimately, the goal is long-term wealth creation through good companies, long holding periods, and the power of compounding. When everything is simplified, his entire philosophy can be reduced to one powerful cycle: observe, understand, research, invest, hold, and review. And the ultimate lesson is clear: you don't need to be a genius or a professional to succeed. You just need to follow the right process consistently as a careful observer, logical thinker, and patient investor. The true message of One Up on Wall Street is not just about stocks, it's about mindset. Investing is not about being the smartest person in the room. It's about being curious, disciplined, and patient. If you understand what you own and why you own it, you already have the one up that most investors are missing. And that's a wrap on One Up on Wall Street by Peter Lynch. If there's one thing to remember, it's this: great investment opportunities are often right in front of you. You don't need to be a Wall Street expert to build wealth. You just need to observe, think, and stay patient. Now I want to ask you, what's one product, brand, or business you personally use that you think could be a great investment? Let me know in the comments. I'd love to see what you're noticing in your everyday life. If you found this video helpful, make sure to like, share it with someone who wants to grow their money, and subscribe to Money Library for more simple and powerful lessons on wealth and investing. Until next time, keep learning, keep growing, and keep building your money mindset.